Let's assume you're given $1 million today. Are you confident enough to make the right financial decisions? Perhaps you'd buy some Bitcoin, or buy in some creme de la creme NFT projects for some explosive gains. How about some Pokemon cards? Just make sure they're not fake. Perhaps you finally have the chance to build your effortless bulletproof dividend portfolio, where money just comes in no matter what. Or you would choose the riskless investment of all times and simply buy an index fund.
No one has ever lost any money if they've bought and held an S&P 500 index fund for more than 20 years.
Now, despite the popular belief, if you had invested in the S&P 500 in 1929, it would have taken you 30 years just to come out flat. Before you take anyone's word for it on YouTube, just think about that for a moment. 30 years is a third of your life. That must be a one-time thing, right? Yet if you bought the same index fund in 1966, it would have taken you another 26 years before you saw any profits. That is 56 years of lost investments in 63 years. Well, of course, you're smart enough to know that if you just buy and hold it, you'll always make money. And you're right, if you held on to your S&P 500 index for 63 years, you would have made a whopping 59% return. That is 0.7% annualized. And if you factor in the 3.4% average inflation during that period, you would have actually lost 2.7% per year. In other words, your $100,000 in 1929 has lost 82% of its purchasing power by 1992. We all know that the educational system does nothing to teach us on financial literacy or entrepreneurship. This creates a big problem. Where do you start to learn these critical money management skills? Unless you have financially savvy people in your family or friend circle, your chances of getting the right money management skills to grow your wealth are slim. According to Sarah Stanley from the book The Next Millionaire Next Door, 70% of millionaires in the US have said they know more about investing than most financial advisors. Do you feel the same? Then you have YouTube, of course, where you have endless videos of YouTubers highlighting to you that they're millionaires. They're telling you that you must do this now to become a millionaire, as if they became millionaires by doing that. And if you follow them word by word, you would become one too. Unless you want to YOLO your way through the $1 Million Club, you would have a much better chance of becoming a millionaire if you spend your energy on learning how to fish rather than searching how to be given one. As Benjamin Franklin said, an investment in knowledge pays the best interest. Welcome to Financial Interest, where we will teach you everything you need to know about money and investing. Please like and subscribe if you enjoy the content. You found out that one of your friends bought a popular program from a YouTuber and started day trading, as that's the thing to do these days. It's so cool and straightforward. Everyone seems to be turning 1,000 into tens of thousands in weeks. How hard could it be to flip some currencies up and down with some leverage, of course? A set of monitors, 2 free YouTube tutorials, and you're good to go. You straight go to Amazon and buy as many monitors as you can fit into your room. As if how much money you make depends on how many monitors you have. And now that you're well equipped, it's time to learn some technical analysis. It does get a little confusing at first, but you keep telling yourself, if all your friends can do it, why can't you? And you're right. After a couple hours spent on YouTube, you start getting the hang of it. RSI and MACD alongside your beloved moving averages become your best friend. And you're finally ready to start trading. You recall that trading strategy from YouTube and decide to apply it. The guy's a millionaire with a Lambo parked in front of his house. He definitely knows what he's talking about. Your initial trades turn out to be pretty successful, which only later you realize was the worst thing that could happen to you. With your confidence peaking, you increase the leverage in your trades. You soon start losing far more than you had initially made. Your initial 1 million dropped to 900,000 and then to 800. Only one thing goes through your mind at that point. How can you make back what you lost? You think about asking your friend or that trading master you started following on Instagram. He probably knows what to do. But by now, the 800 is already 700. As you get more and more drowned, you soon realize that you have joined the rest of the 80% of all day traders. And before losing all your hard-earned money, you realize that this type of trading is more suitable for highly experienced financial experts or fortune tellers. Investing in the short time frame is emotionally draining and reminds you more of a roulette table than anything else, especially when you don't know what you're doing. You now see that most of those self-proclaimed investment experts make their profits from selling courses to people like you, rather than the trades they claim to have. You have now realized that understanding the risk of any investment you make is crucial, no matter how tempting the potential profit may be. Congratulations, you learned your first lesson. what has worked for others may not work for you. Just because everyone claims to make money doesn't mean that you will. Before you jump into any investment, always question whether this type of investment style is suitable for you, and not the proclaimed lifestyle your guru pretends to have. By now, you don't want to lose more money. And before making any bad decisions, you decided to learn more about the concept of risk. As you read through the articles, you notice that risk and reward is highly correlated. And the more you read about it, you realize that the concept of risk and reward is far beyond finance. You imagine yourself on a plane, about to make your first skydiving attempt. Your body is paralyzed. You have mixed emotions. On one hand, you're experiencing a level of excitement you never felt before. And on the other, random facts race through your head of how many people die from skydiving accidents. The decision of whether to jump or not is a result of your risk tolerance. If you consider the risk to be too high compared to the reward, you will not jump. All of a sudden, everything makes more sense to you. You realize that every decision you make has its own inherent risk and reward. And while investing, the better you can understand the consequences, the easier it is to make decisions. Scrolling through your Twitter feed, you see that there is not a single person that is not talking about NFTs. You don't really know much about it, nor does the weird images of cats and apes make much sense to you. But hey, everyone's making 3, 5, or even 10 times their investment. You feel like the risk and reward is in your favor this time. The famous projects are already too expensive, and according to YouTube experts, there is not much upside in them. So you try to find some new projects. You're fully aware of the risky nature of this investment, and you can potentially lose a large chunk. But the upside potential is too enticing. So you go ahead and buy yourself a bunch of Big Daddy apes, only soon to realize the project is worthless. Now, despite the fact that you expected to lose some money in the worst case, you thought that you had a much higher chance of making money. Disappointed with yourself, you revisit the topic of expected return based on risk and reward, and come across an example of a roulette table. When you bet on a single number and get it right, your expected payout is 35 times your investment. Sounds even better than these NFT projects, right? But your chances of getting it right is 1 in 38, which equals to 2.63%. And if you get it wrong, which is highly possible, you risk losing all your capital. In this case, the expected return would be calculated as such. So is this a good investment? The answer is simply no. Congratulations, you have learned your second lesson. Whether you have the chance to make 10, 20, or even 100 times your investment is meaningless, without knowing the realistic probability of that to happen. In any investment you make, your expected return should always be positive. Otherwise, your investment is not much different than buying a lottery ticket, and you would not be investing, but rather gambling. While hopelessly looking for a way to make back what you have lost, you come across many YouTube videos talking about the metaverse. All of a sudden, everyone seems to be an expert in the field. The message is clear. If you have missed all the previous trends, this is your chance to catch up. You are told that if you get in early, the upside potential is huge, and you'll become a millionaire in 1 year. It seems very promising. While asking yourself which companies to invest in, you see that almost every video gives you a list of top stocks that will revolutionize the metaverse. If 1 million people are subscribed to him, he can't be giving bad advice, right? Despite even a person like Jeff Bezos, the founder of Amazon, shies away from predicting who will come up top out of the internet boom in an interview in 1999.
Long term, I believe that it's very easy to predict that there are going to be lots of successful companies born of the internet. They're going to have very large market caps and so on. I also believe that today, where we sit, it's very hard to predict who those companies are going to be.
After having bought the 5 most recommended stocks with the largest views, you feel pleased with yourself as you have now invested in a sector with huge upside potential. A few weeks go by and your stocks significantly appreciate in value, in fact much more than the S&P 500. You feel like you finally got the hang of it, even to the extent that you're beating all your friends that are invested in index funds. Yet one morning, you're surprised to see that one of your best performing stocks is down 15% pre-market. After reading the news, you find out that they have missed on their earnings target. You were up 30% in just a couple weeks, and now half of it is gone. You feel the temptation of buying the dip, as that's what seems to be the best strategy these days. While still thinking about it, the price of the stock falls again, and it's now down 30%. You check your other stocks and the same thing happens with 4 of them. You are confused. Wasn't this supposed to be a sector with huge upside potential? You feel bad, stressed, and overwhelmed with all the red graphs. You need to cut losses. If you sell now, perhaps you can buy it at a lower price again. This way you would lower your average cost. The situation is driving you crazy. You don't want to lose more money, so you decide to sell everything. Even that one stock that was actually doing pretty well. As painful as it is, you have accepted defeat once again. Yet out of curiosity, you keep checking the stocks you had once owned. And seeing them continuously falling makes you feel better. You took a good decision by selling them. A couple weeks go by and the stocks you had sold have now recovered in price, before you could even think about rebuying them. You realize once again how important it is to really understand what you're buying. You keep telling yourself only if you knew how material the impact of that earning miss was on the future value of the company. Or perhaps single stock trading isn't for you, and you should stick to more broad-based indices. Congratulations, you have learned your third lesson. It is now very clear to you that the only way to resist stock market volatility is by having a solid understanding of the risk and reward profile of your investment. Rather than taking others' word for it, it would have been much better if you had done your own research. If you made it this far, I hope you enjoyed the visualization of the common mistakes people make when starting their investment journey. I'm personally a fan of most of the content creators mentioned in the video, like Stephen Graham or Andre Jick. But when it comes to taking financial advice, despite not being financial advice, it's better to be a bit more selective, especially towards videos that tell you buy this or that. Keep in mind that if someone has a proven investment strategy that can turn 5k into $1 million, they would not be making YouTube videos, but rather collecting a large sum of money from ultra high net worth people and running their own fund. Even though videos that summarize the current market state without over-dramatizing the situation for some clickbait are usually enjoyable to watch. At the end of the day, purely from an entertainment perspective, everyone is making great content. As a disclaimer, the investment products mentioned in the videos such as index funds, dividend portfolios, or even alternative investments such as NFTs, cryptos, and collectibles are all viable investments that can grow your wealth, as long as they are well understood with the risk and return profiles, and the right amount of your total wealth is allocated to each. Most of the time, these investments are presented as, buy these if you want to be a millionaire, highlighting only the upside potential of the investment. This can be very misleading and creates that illusion as you're missing out and you need to act now. That is not very true. Before you invest in something, you should at first invest in the time to understand it. We will have detailed videos of all the topics discussed in this video in the next couple weeks. So if you'd like to stay tuned and support the channel, don't forget to give it a big thumbs up and subscribe so you don't miss out.